Hello, you are watching a very special edition of Berman's Call, the Solar Eclipse edition. I don't feel like I need these right now. I did have the super powerful ones, but I'm not in the vicinity of the sun. You can kind of tell it's getting a little bit darker behind me. It kind of has that aura of like, maybe it's going to rain, but we know that's not happening. It's actually just getting darker. Larry, you're in the studio. You've been taking questions and emails as you do for this show, but today's educational segment is really aptly timed. You're talking about these solar stocks, for no other reason other than why not talk about these solar stocks when the sun probably has never gotten more airtime than it is today.
Absolutely. Actually, the first ETF that came out was very, very poorly timed from a historical perspective. We have a chart here, first came back in 2008, and all will know that that was in the middle of the great financial crisis. There's a saying about looking into the sun, and the sun's not more dangerous today than it is on any other day. The radiation coming off the sun, whether it's an eclipse or not. But today we have more interest in looking at it, which does make it more dangerous. So when it comes to investing in these stocks, one narrative here is that you've got to buy it at the right time. This is an industry that's new, it's growing, it's got decades of growth ahead. But clearly, investing in the ETF and the sector, 15 years ago when it first kind of hit the markets, today you're in a lot of pain. From holding it so long in the portfolio. There are three things here, Amber, about the sector from an investment perspective. Maybe we can have a little bit of chat about. But the good news is, there's a lot of growth and demand, coming now and in the future. And there's a number of stocks within these ETFs that are well suited for that long-term demand side push. And there's some names there that you can see on the screen.
Absolutely. It's one of those kind of concept sectors where we were kind of told, and you can include other green energy transition concepts. I just want to go kind of full screen if we can, because you can see behind me, it is getting really dark. We're at the point of almost 100% occlusion. And I just want to make a comment about the birds. The birds are not flying. The birds are kind of just sitting very calmly at the edge, but it makes it kind of eerie out here. Maybe, Larry, you did choose right. It's staying in the studio, but definitely getting darker now. And to your point, back to what you're talking about, the solar stock, like it's one of those things where it's a concept, green energy, solar, it all sounds so right. And here we are talking about $86 oil, and strategist after strategist saying, even Jamie Dimon, right, in his letter today saying, oil is not going away overnight.
Yeah, when these stocks first came out, when the ETF first came out, back then oil was trading north of 100 and heading higher, and so the competition to green the world when oil was so expensive, but really ever since oil's gone flat to down from there. Some of the dark aspects of the industry is that prices are falling, so that's good and bad. That's good for sort of the end consumer. It's becoming cheaper and it's more affordable. The bad side of that, if you think about some of the warnings, interest rates are very high. For the average consumer, they've got to finance the purchase of solar and whether they put that on the roof or whatever. So those aspects of the industry are very, very negative. And I think when it comes to being tactical and when is the best time to invest. A year plus ago, when the Inflation Reduction Acts came, it was August of 2022, US passes this bill, it's gonna cut inflation, they're gonna spend a ton of money on green energy, and these stocks already fully priced that in. I don't know if we bring that in, but in anticipation of that, there was a lot of companies that ramped up capacity and production. And so here's some names that were actually hurt by that aspect of it. And so when you buy a broad ETF like TAN, you get exposure to the ones that sell it to the consumer, the ones that are manufacturing the component parts, and ultimately the ones that are putting it all together and selling it. So it is broad-based. And so right now, the big beneficiary and the names are going to be more from the ones that are going to profit from the expansion of the overall industry versus the end sale point to the customer.
Larry, Barry, as you're talking, it's gone sort of pitch dark outside. I really wasn't expecting the magnitude of the darkness, and quite ominously, now we've got sirens kind of going off, which kind of feels apropos of the mood, but it's basically pitch black out here. And as you're talking about kind of what's happened with these solar stocks, and I'm in the pitch dark, I wonder what it would take for you to put a little bit of sunshine in your portfolio. What would it take for you to feel like you can get interested in this sector? What are some of the criteria you're looking at?
Well, I should say in that darkness there, Amber, you're a ray of sunshine. So you're brightening up the screens for investors here. I have one final chart to show here. And this is one put together by Bloomberg Intelligence in terms of the valuation. And what they're looking at is the enterprise value to EBITDA of the broad entire world index, and then where these EV stocks are trading now. So you could see, not EV stocks, but solar stocks. And you can see on the eve of, the valuation of these names on the Inflation Reduction Act, they were extremely expensive and overvalued relative to where they are now. This is actually a pretty darn good time to start getting interested and adding to these to your portfolio.
All right, that's good perspective. We made it. We did a full kind of solar eclipse show. We saw that here I am in the dark, and I think we can show a live shot of kind of where things stand. I'm not sure if this feed is from Quebec. Of course, NASA and others have been feeding. This is a live shot of Quebec. It explains some of the darkness I'm seeing here in Toronto. What's fascinating about this is just the broad swath of people that are able to see this. I mean, eclipses themselves, they happen all the time, between 2 and 5 times per year around the world. What's fascinating about this is just how many people are able to see this. 31.5 million people where they stand can just walk outside and see this. And there we're very close to a full total eclipse. It is, if you come out to where I am right now, pitch dark.
Welcome back. It's time now for On the Radar, when we ask an investing professional what they're looking at in today's markets. We're back again with Colin Szysinski. He's Chief Market Strategist at SIA Wealth Management to talk about the rallies that we've seen in several key commodities, a couple of big ones. We've talked about gold already. Let's talk about oil and copper. We'll bring up a one-year hot graph of the price of crude oil. We touched on it at the beginning of the show. It can have a material impact on inflation, of course, because higher oil prices mean higher gasoline prices. And you can see how much the price of oil has run since the early portion of December, let's say, up from the sub $72 level, about in the high 60s or so, now to 86.55. Colin?
Yeah, so we've seen that's a huge run for crude oil, and there's a couple of things that are driving it. Several factors. So the first one and the big one is China is coming back. A few weeks ago, they announced that they were going to be bringing in various stimulus measures. People thought China would take off in 2023, and it didn't. It struggled all year, and that dragged on commodity prices. But we're starting to see it in the data. We're seeing it in the announcements that China is starting to improve this year. That boosts the demand for resources in general, but particularly crude oil, copper benefit from that. We talked about in the show already that the North American economy has been quite strong. That shores up demand for crude oil and resources as well. And the other one, then we look over at the supply side, and with the Americans had held the price down with draining oil from their strategic petroleum reserve. They've stopped doing that, and for a while it looked like they were going to become a buyer. They've kind of backed away from that. But they're not putting more supply into the market. And at the same time, with all the various conflicts we've got in Russia and Ukraine, is here and there, it is having an impact on supplies as well. So you're in a situation where demand is improving, supply is somewhat being constrained, and the price is taking off.
Yeah, the first thing you mentioned was Chinese demand. That's the big factor, is it?
Absolutely, and we're seeing that particularly in the price of copper. Copper is acts almost as a proxy for what people think about China's economy, and what we've seen in the last few weeks is it's exploded. Once it got through $4, it just took right off. So it's an indication, because copper is used in anything, and there's so much demand for it, particularly from emerging economies that are building things, that to see the price of copper goes really is a sign that people are thinking that China's demand will increase.
Let's take a look at a couple of stocks. Speaking of copper, one of the ways that Canadian investors can gain exposure to copper, of course, is Teck Resources, the Vancouver-based mining giant. It's certainly not a pure play on copper, but it mines a lot of the metal, and you can see its share price has rallied significantly. What do you think of this chart, Colin?
I mean, it looks very strong here. It's broken out of a downtrend that was in place for most of the last year, and breaking through 54, 55 was very strong. We're just seeing these resistance levels one after another getting taken out. Also, that big rally, a bit of a pause and a rally again, also a sign of strong underlying accumulation.
Other metals have also rallied. Teck is a big maker of miner of zinc, of course, in addition to copper. Zinc has also rallied, not as dramatically as copper, but it is up as well. Here's a stock that many generalist investors consider the way to invest in Canada's oil and gas sector, and that's Canadian Natural Resources. Gets a lot of attention, a lot of praise these days from portfolio managers who include it in their portfolios. And there you see what that stock has done during roughly the same period of time, up in a big way. Colin?
And that would include us. SIA Wealth does hold Canadian Natural Resources in portfolios that we manage and advise on. And you can see here the improvement in the stock for the second half of last year. It was just kind of bouncing around between 80 and 90, but in the last 2 months now, it's come under very steady accumulation, very consistent gains, and it's been climbing in our proprietary relative strength rankings, where we measure how stocks are performing against each other. Canadian Natural has been moving up along with other oil and gas companies, and it's been very strong, as we can see, clearing $100.
And let's we talked about gold in our previous segment. Let's take a look at one of the flagship Canadian gold mining stocks, Agnico Eagle Mines, one of the big ones. It has enjoyed a substantial rally since the middle portion of February.
Yes, and that was another one that's just had been going sideways, had been in the base building for a long time, had a rally in February, paused a bit to consolidate, and now it's in another rally, and it's broken out over 81 to a new 52-week high. So a lot of new interest has come in behind it.
And I asked you earlier this, but why don't we revisit it? A lot of investors see a disconnect between the strong price of oil and, in the case of some mining stocks, some underperformance given the metal. What have you seen with respect to relative strength in the gold mining stocks?
Gold mining stocks have been improving. The energy stocks started to move up first, but now we're starting to see gold and base metal stocks climbing as well. We're definitely seeing capital flows and rotation based on our measures.
We are about to get a decision on interest rates from the Bank of Canada. Warren Lovely, Chief Rate Strategist at National Bank Financial, joining us here. And Warren, thanks for being with us. We're not expecting a change in rates, but what are you watching for today?
Yeah, well, there's going to be a lot to unpack here, John. So in particular, the guidance in terms of future rates as we try to handicap when we might get that first interest rate cut from the Bank of Canada. So the language there will be quite key.
And what is the balancing act for the Bank of Canada at a time when people are struggling with higher interest rates, but we're still not seeing inflation at their so-called target level?
Yeah, so it's not at the target yet, but we're making progress. Slow progress to some extent, but moving in the right direction. So this is really what we're looking for in terms of how the bank is viewing the progress.
All right, and we did just get that Bank of Canada interest rate decision. We are seeing the Bank of Canada keep rates at the 5% level. That, of course, is what was expected. Ultimately, the Bank of Canada, some of the key takeaways here from the decision today is that while there are still some areas of focus for the Bank of Canada on the inflation fight going well, they want to see more evidence. So this becomes the 6th consecutive meeting. The Bank of Canada officials have essentially signaled they're getting closer to rate cuts, but just still need more evidence, leaving that benchmark overnight rate unchanged at 5%. I'm going to read from the prepared text from Tiff Macklem, the Bank of Canada governor, in his opening statement saying, quote, "We are seeing what we need to see, but we need to see it for longer to be confident that progress towards price stability will be sustained." Now, overall, the communications confirm that officials in their discussions have turned to debating when interest rate cuts can begin this year. But it does feel like that decision is ultimately going to hinge on how inflation evolves in the coming months. Now, in the accompanying monetary policy report, the officials did share some expectations on growth for Canada. They are looking for the economy to grow 1.5% this year, up previously from 0.8%. They also boosted their outlook for potential growth. They said they expect, quote, moderate excess supply to persist until the end of 2024. On inflation expectations, policymakers see inflation falling to 2.2% by the end of this year, a slightly faster deceleration than what was previously expected, and officials continue to see inflation hitting the 2% target in 2025. So getting to that target level by next year. They do estimate yearly price pressures at around 2.9% in the second quarter. Officials also raised their estimate for the so-called neutral rate, which is a theoretical level of borrowing costs that neither stimulates nor restricts the economy, by 25 basis points to a range of 2.25 to 3.25%. It is interesting, though, Canada's progress on inflation arguably starting to diverge from the U.S., which saw some upside surprises to price pressures in January and February. And of course, we just talked about the March numbers coming in hotter than expected in the U.S. today. We're still waiting for the CPI numbers for Canada for March that'll come next week. Let's get some instant reaction from Warren Lovely, Chief Rate Strategist at National Bank Financial. So let's start with the fact that they are keeping rates where they were. Not going to surprise anybody outside of maybe a couple of fringe people who thought perhaps they'll cut today. I think everybody was very curious about what the language would tell us about the path towards rate cuts. What's your assessment?
Yeah, so a quick reaction here, John, is this seems like a pretty appropriate statement, in my opinion. Look, the Bank of Canada has been a little bit harder to handicap than some other major central banks. The governor, deputy governor, governing council has kept us on our toes in past decisions. This one seems about down the middle of the fairway in terms of our own expectations. We didn't really expect any premature move to ease. You do see the acknowledgement that progress is being made on inflation. I think quite sensibly what they're telling us is, look, we want to see more evidence. We want to make sure the progress we're making is durable, sustained. I think what they're saying, if you read between the lines, is if things continue to evolve the way we expect on inflation, it will be appropriate to lower interest rates this year. So we're still waiting. We didn't get that cut today, but it seems like it's coming, just with a little bit more CPI evidence in hand.
Last time we spoke with you, we were talking about directionally, once there is a commitment to lower interest rates, what that path looks like. And we had a conversation with Ed Devlin earlier, who feels pretty strongly that once they make that commitment, that we're not really dipping our toe into rate cuts. Not that it has to be dramatically lower, but you are committing to that path. And so this idea of wanting to ensure that you're ready to move in that direction and not have to move back into the other direction because of inflation lingering is, I guess, the challenge that they're dealing with right now.
So anytime you make an interest rate decision, you have to justify that decision. So today they've opted to keep interest rates on hold. So they need to justify why they're not cutting. And what they're saying is progress is being made. We need more evidence. So when we get to that sometime down the road, when they are cutting, they'll need to justify why they're cutting. And I tend to agree with that. I don't think you're going to be expecting them to do one cut and be done. There will be a series of cuts. I think the debate, John, is really about the precise timing. June, July seems like the appropriate window at this juncture, and the pace. And I think what we might expect is if the economy is showing some resilience, we might not be cutting at a breakneck pace. It might be a slower pacing to the relief, but relief nonetheless.
We are taking a look at the currency reaction to this decision from the Bank of Canada. So once again, keeping rates where they've been, that's not a surprise. really the language, if I'm going to interpret what Warren was just telling us, probably not that shocking either, in that there is still that fight against inflation playing out, but there is more of a willingness to talk about directionally getting ready for lower rates. The loonie had been stronger, the loonie had lost some momentum this morning against the American currency because we obviously saw that hotter than expected inflation print. Ultimately, we saw the loonie trimming some of its declines against the U.S. currency after this Bank of Canada decision, because it sort of indicates that we're not in the same boat, Warren, but a similar boat, in that central banks are just struggling with this pivot towards rate cuts right now?
Well, I think what you're seeing in currency markets is a little bit of an attempt to handicap which central bank blinks first on interest rate cuts and moves more aggressively. And I think what the Canadian dollar is telling us is that there's greater conviction that the Bank of Canada will go ahead of the Fed. And that's leading to interest rate differentials that are putting some pressure on the Canadian dollar. If you look at that US CPI data this morning, strength, hotter, under the hood, a little bit disappointing now 3 months in a row for US inflation setbacks versus expectations. We're seeing some progress here. So that differential, that distinction, I guess, between policy expectations is helping to influence the Canadian dollar.
How do you feel about the state of Canada's economy? It's a very unusual time in that, in the stock market, we've got a record high. That's great if you're invested in equities right now. But I think on the street, in this environment, even though we use words like resilient economy, et cetera, people feel a little bit meh out there. Those higher interest rates, they have all these ripple effects, right? Even in the housing market, if you've got a mortgage, you got to deal with the borrowing costs. If you're not a homeowner, you got to deal with the reality of higher rents right now. So the inflationary forces that actually come from higher interest rates. So that's one of the sensitivities of our Canadian market with the household debt. It's maybe one of those differentials between Canada and the U.S. that you seem to be alluding to. How would you characterize the state of our economy right now?
Well, I guess considering that we're at a 5% overnight policy rate, the economy is reasonably resilient. So by that I mean at 5%, some old models might have suggested we'd see even greater pain and deceleration in growth. If anything, we've got a little bit of a pickup in growth. We're seeing labor markets soften, but still relatively healthy. I think what you're alluding to, and I tend to agree with this, is that Canadians are feeling under strain, however, right? We know there's an affordability crisis, if you want to use that word. We know that consumer sentiment has softened, and we're not done in terms of adjusting to higher interest rates. That's the great irony, is we may in fact have the Bank of Canada cutting interest rates, and we'll still be going through a painful mortgage refinancing episode all through this year and next year. So monetary policy works with a lag, and we're still not feeling it entirely.
The S&P is holding its own, but yesterday stocks came under pressure after yet another hotter than expected U.S. inflation read. We did see some pressure on bonds today, pushing yields higher. But you can see the S&P 500 up today and up around 1% in the past week. Well, what about these reduced expectations for Fed rate cuts? We're joined by Mark Sebastian, founder of Option Pit and Chief Investment Officer at Carmen Line Capital. Mark, it's always great to talk to you. So we're hearing that some investors are looking at the prospect of no rate cuts this year. Maybe that's a bit drastic, but stocks are holding in fairly well.
Yeah, and so you got to ask yourself, if you were a bear, well, interest rate, the cuts that you didn't think were going to happen aren't going to happen, and the market is still holding up. So maybe there's a different story here. Maybe this rally wasn't just built on hopium from three Fed rate cuts, but maybe it really is this AI revolution, strength in oil, strength in energy, strength in the U.S. economy, pulling the overall market higher. That being said, we're in kind of a funky area right here, where we're probably overdue for at least a little bit of a pullback. We've not had 2 days of the S&P closing below its 21-day moving average since January 3rd and 4th. We were we're back over the 21-day now. So if we closed here, that would continue that streak. But definitely the S&P looks a little shakier than it had the entire year through probably last week.
So we have an S&P 500 at 5,200 roughly, not far off the record high of last month. And you're saying that we're above, the market is above its 21-day moving average? Yeah,
the 21-day is about 51.98. We're trading about 52.06, so we're right above that, but not strongly above it. We could easily fall back below. What kind of shocks me is that bonds are getting beaten and have gotten beaten over the last couple of days, and the S&P is more or less shaking it off, which many people wouldn't have expected. And one of the reasons why you have to ask yourself, maybe there is a forward-looking fundamental story to this market, and it's not just interest rate hopium.
That's interesting, that AI will, in fact, unleash profitability. You say some names are looking attractive here. One that interests me, Freeport-McMoRan, a classic play on copper, FCX.
Yeah, FCX has had a really nice run. Today, pulling back a little bit. I'd like to see it pull back a little bit more, but that one gets back toward 47, 48. I'm a buyer. It's a play on one, inflation continuing to be a little bit of a thorn, but manufacturing and materials continue to rally. We've seen a pretty strong run in materials. An interesting name, I know I sent you a few of these materials, that one that I hadn't really looked at till I saw some unusual call options trading was MP Materials Corp, ticker symbol MP.
Okay.
This is a rare earth company here in the United States. And it looks like it's gearing up to break out.
Okay, MP Materials. I haven't heard of that one. A name, market cap of about $2.8 billion. Just on the data centers on copper, I referred to it earlier. According to Jefferies, their base case is that global copper demand in data centers will rise from about 239,000 tons last year to almost 500,000 tons annually by the end of the decade. So these data centers alone will use loads of copper.
Yeah, absolutely. It makes FCX really attractive as the huge copper copper miner they are. Long term, it's sitting right off its 1 year high. And really sitting off at 5-year highs. But if things really get booming, this thing could go to $60, $70 if that demand materializes.
That's Freeport-McMoRan.
Yes,
FCX. Okay. And JP Morgan, we're expecting earnings from them tomorrow. People think this stock is untouchable, the magic of Jamie Dimon. What should we look out for?
Yeah, so it's had a really, really nice run. And right now, markets are pricing in a bigger than normal move. Now, I'm not going to guess what direction that is, but normally they're looking for about a 2.5% move. Now they're currently pricing in a bigger move than that, about 3.5%. So there's definitely some interest around this. And I'd be expecting, especially on a miss, we could see a pretty big move to the downside if they do report soft. On the upside, it's trading 196. If it's trading 190, it's usually going to 200. That would be your upside target there if they report some decent earnings. It'll break 200.
Meanwhile, it's no secret Canada's media industry is going through big changes. The most obvious one is tied to how we consume content. In a world where Canadians spend an increasing amount of their time on social media while also watching more shows on streaming services, broadcasters are in transition mode. And Chorus in the media sector is warning traditional TV advertising remains in a slump. That has left the company focusing on what it can control in the short term, things like expenses. Earlier, we spoke with Doug Murphy, the president and CEO of Chorus. He spoke about some of the changes the company has been implementing.
Well, we have made great progress in what we describe as our video-first strategy. That's moving beyond being a television broadcaster to being an aggregator of premium video content across all platforms, linear, digital streaming. We do that with our Pluto TV, which we launched a year ago, now the biggest fast channel, free ad-supported streaming television in Canada. We have the Stack TV, Global TV app, and others. So from an audience delivery perspective, we just had a new schedule launch, which you referred to. We can talk more about that on Global and across all of our specialties. And it's got off to a great start, and that's positively influenced all our streaming platforms, of course, because it's the same content in many cases. So off to the races on an audience perspective. The challenge is demand.
The demand, and explain what demand means.
Well, that means, so our business is, in its simplest sense, every eyeball that watches our TV shows, our linear services, our platforms, or listens to our radio is an impression that we sell. So if you get audience growth on your video services, then you try to sell that to advertisers, and we sell impressions as CPM, cost per thousands. So what's missing right now in the sort of equilibrium is demand to buy that supply. So we now, as an industry, it's not just a chorus thing. In fact, it's a worldwide thing. Traditional broadcasters still are delivering more audiences than advertisers want to purchase. We think that is going to change. And I can talk about that, but at the moment, that's the picture we're looking at.
I know you talked about, last time you were with us, you talked about this being a hope for recovery year of sorts. What changes the demand equation, do you think, that you were just talking
we made
about?
sequential improvement in the last quarter, improving off the prior, negative 17, negative 14, still negative. We were hoping to be better still in our third quarter, but our outlook is now 10 to 15 negative. And that really is because we're halfway through the quarter. Despite really good audience delivery, we're just not seeing the demand coming back. Now, the thing that I think is important to understand is television trades in in 4 month intervals. So the advertisers on TV now bought television 4 months ago, 3 months ago. So broadcasters need to have good audience delivery, and then you sell that for the next segment. So we all have our upfronts coming up. Bell has theirs, Chorus has ours, and then that's in June. We'll sell audiences in June for the fall schedule.
And so you're preparing for that. Cost cutting, though, was part of the message today. You have been involved in cost cutting. Look, all companies have. Ours has as well. But you did allude to the fact that it doesn't sound like that's done.
Unfortunately, it's not. So our total OPEX was down 13% in this last quarter. In the first quarter, it was down 17%. This quarter we were down $38 million. We're down for the full year 15%, $88 million of cost. We still need to find more cost because absent a meaningful revenue recovery, all of us need to find ways to offset those declines. And frankly speaking, it's an opportunity. It's an opportunity for us to get really focused. So if video first is the audience strategy, our cost strategy we call Fit for the Future. And that's about streamlining our operating model and rationalizing our asset base. We sold a non-core asset, Toon Boom, you might recall, over the summer. So we're inventing new ways of doing things, and we're really challenging everybody in our company to prioritize. If it's not in service of video first, then why are we doing it?
Yeah, and then in terms of the dialogue that you're having with creditors, how are you dealing with the debt? Because that's another reality when there's top line pressure.
We made the difficult choice to suspend our dividend in the last year, and this year so far we paid down. We had a great cash flow. You mentioned our free cash flow is up nicely, $33 million versus $28 the year prior. We paid down more bank debt. We're now $32 million we paid off so far this fiscal. Leverage came down 3.67, 3.62. So it's going in the right direction, and we work hard to make sure that we're demonstrating our commitment to reducing our leverage as part of our capital allocation strategy.
And what's the conversation like, broadly speaking, let's say with equity investors? So people have seen your stock's been under pressure. The valuation has come down significantly since you became CEO as well. But if I were to be fair here, if I look at Disney's stock chart, which went up and then down, or if I look at Paramount's stock chart, right, all the industry has been going through change over the last 5 to 10 years, and some of your key stakeholders are the Shaw family as well, so that's a constant conversation. But what is the conversation like with investors at this point?
Well, if you're investing in media and entertainment companies, you have to have a strong stomach right now. It's been a challenging go for, as you rightly know, a number of years. But I think all of us are, in their own way, employing this video first. Everybody's trying to find ways to launch a streaming product, to offset the declines in linear television viewing, and then to monetize those across all platforms. So that's the answer.